All right, welcome to this month's Capital Markets Update and Outlook Call. We are live here in Eden Prairie at our office. We've got not a full house, but maybe a half house. For those of you in Minnesota, you know we've got some weather happening right now, so that did keep some people home here today. But I just want to take a second to welcome all of you guys here. Thank you for coming out here today. I do appreciate you taking the time out of your schedule. We are also live online on our website, on YouTube, LinkedIn, Facebook, getting this message out. So to all of you who are watching online, I want to say welcome. Thank you for being here today. Appreciate you taking the time. And then lastly, I know a lot of you watch in the recording later. So if you are watching in the recording later, welcome to you as well. Thank you for taking some time out of your busy schedule to do that. If you are new here, my name is Eric Hagan. There we go. I'm a financial advisor. I am president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, of financial advisors Dan Oshman, Rana Grant, and then our client support team, John Knutson and Marilyn Westmark. Together, our goal is to help the people that we work with make their next financial decision, and the one after that, a good one. We primarily do this two ways. We can help you see your entire financial situation today, as well as every year into the future through our personal wealth planning services. If you'd like to learn more about this, I encourage you after today's call to go to our website, clearfinancialfuture.com. There's a short 2-minute video where you can learn more about that. And then secondly, our fiduciary investment management solution, something we call SmartMix. SmartMix is our personalized solution for individual investors. Whether you have $25,000 or $25 million, the goal of this solution is to help you individually get and stay invested right. If you'd like to learn more about that, you can go to smartmixportfolios.com. We keep our finger on the pulse of the markets and the economy every single Monday. I go online. I do a short live broadcast summary of what's happening in the markets. Try to cut through a lot of the noise that's out there, focus on the facts of what's going on in the markets. You can join on your favorite platform there as well, whether it's LinkedIn, Facebook, YouTube, or on our website. Later on that day, I send out an email. So this email, I try to put anything and everything that we have going on here at the office, financially investment related. So if you could, please, if you're not getting that email, I encourage you to go to our website, subscribe to that email. Comes out about 3 o'clock Central Time on Mondays. And then secondly, take a few minutes to take a peek at it. Instead of blasting you all the time with all sorts of emails, I try to put it all into one once a week. So if you could take a few minutes just to glance at that, that would be very, very helpful. All right, today we're going to hear from our Chief Investment Officer, Tom Fox. Tom is going to review the positives in the markets. There are positives. He's going to review the headwinds that we're facing. There are headwinds. And then he's going to talk about his outlook for the balance of 2023. This is kind of your opportunity to look over our shoulder and see what we're seeing. Tom spends most all of his time kind of behind the scenes doing the due diligence, the research, the analysis, and really focusing his attention on the markets and the economy and all of the data that we're constantly analyzing. So if you're watching this online, feel free to use the chat box or the comment section to ask any questions while you're listening to Tom. I will be watching that, and I'd be happy to field those questions and get them to Tom for you at the end. Of course, those of you here live in person today, love to take your questions at the end as well. So with that, I'm going to turn it over to Tom. Tom is traveling. He is in Nevada, I think he said. So I'm going to bring him on here. Bear with me here a second. All right, Tom, are you there?
Hello, everybody. Hello, Eric. Good morning.
All right, wonderful. Technology is wonderful when it works, right?
It is. All right. So we'll begin this outlook for the rest of the year. And remember from last time we met, it was our theme for 2023 is wag the dog. And what does that mean? Well, wag the dog is an idiom for something of lesser influence begins to influence something of greater. And of course, the dog in this case is the Federal Reserve. And what we think what's going to wag the dog, the Federal Reserve, is the falling inflation. We're going to talk a lot about inflation today because that's the key to both the bond market and the stock market. So we're going to look at a lot of data. We're going to go through what other analysts are saying. And I can tell you this, based on my long history, there is a massive divergence of opinions out there. So we have one, and there's a lot of smart people that have other opinions. And so I kind of listed some of the opinions of other strategists that are on the negative side, and we'll go through those. We call that the wall of worry. Now, we tend to be more on the positive side. Our glass is half full, not half empty. So we're expecting a good year once we get through some of the headwinds that we're facing right now. So the first one is that 3 months of falling CPI still does not convince the Fed. And we see some of the rhetoric that is coming through a number of Fed presidents that have spoken on cable news and so on. So they're not going to change course just because of the 3 months. And that's one of the negative or the wall of worry. The second one is the Fed will continue to raise rates and they're going to go beyond 5%, increasing the odds of a deep recession. And that's what some strategists think, that if they do go beyond 5%, that we're not going to have a soft recession or a mild recession, but we're going to have a deep recession, which would not be good for the stock market. And also, many are forecasting that the subsequent recovery post the recession that's coming will be only 0% to 1.5% growth in 2024. So even after the recession, many are looking kind of like stag. Things aren't moving. The economy is not really recovering fast. It's just sort of moseying along. So that would not be good for the stock market. Fed will keep the ultimate terminal rate, and the terminal rate is a rate that is where they finally come to, whether it's 5, 5.25, 5.5, wherever they end their rate increases, they're going to be there for an extended period. That's what many are saying, that the Fed's going to stay there and be in a restrictive interest rate environment for a long time. Now, also, many are saying the inflation fight's going to get harder and harder as we approach that 2% Fed target and the inflation rate. We've got some information for you that's going to counter this, but it's going to get harder and harder as we approach it. And also that corporate profit expectations remain too high and need to be lowered. So we'll look at the expectation, the consensus right now, and they're saying, hey, it's way too high. We're going to have to be lowered. And recently, just in the last few days, some of the banks have reported. They're the first group that start reporting because we're in earnings season right now, post the end of the quarter. And some of them came in with under expectation, but we'll see how the rest of the companies in the S&P 500 do. So we're just very early. Not many companies have reported yet, but it's coming soon. Another thing is that the the layoffs are going to increase fast. So, and we're already seeing Microsoft is laying off people. Other technology companies are laying off people. In fact, Microsoft said this morning that they're going to lay off more people. So layoffs are increasing. So that could be actually a positive, because that's what the Fed's looking for, is some wage pressure to come down, and that would actually turn into a positive. But it's a negative on the economy. The PE ratio will contract soon. Many expect it to go to 15 or 16 times forward earnings. And that, of course, would drop the S&P and the Dow even further than it is today. And what we're seeing is that when we do get good economic news, it's bad for stocks. So we're kind of in that environment where good news is bad news for stocks. Bad news for the economy would be good for stocks, because that means less pressure on the Fed to raise rates. And then overall, there's a deep skepticism. And there's a number of strategists that are expecting lower lows from back in October, where we had of 22, where we had the low. Many are expecting that to even go down further than the October 22 low. We are not, and we'll talk about that. Okay, so I've put a list of positives together, and there are positives, and we'll go through them and why you should be even buying stocks or holding the stocks you already own. Number one is inflation. Inflation is rolling over hard, and we're going to look at a lot of charts on inflation. 3 lower CPI numbers in our mind is a game changer, and the sub indicators that we look at for inflation for the next CPI are beginning to say this is repeatable. In other words, the trend downwards, there's momentum downwards with inflation, and we think that's going to continue. So we'll get a fourth. We're expecting a fourth inflation drop and a fifth inflation drop and so on. And what the economic situation is, the U.S. economy has remained remarkably resilient. And remember, consumers are 2/3 of the economy. And right now, so far, the data has not been too bad. This economy is holding up much better than many expect. So we haven't tipped over near a recession. But the leading indicators, if you look at the LEI, which is the leading economic indicators, are showing that a recession is coming. But it looks like if it does come, and we are forecasting either a soft landing or a soft recession, we think it's already discounted in the stock prices. So another positive is households still are in pretty good financial shape. We're not seeing anywhere near past recessions where the consumer or the financial household is in bad shape. They're actually in very good shape. And that comes from the pandemic savings that they built up. And rather than they're stuck at home, so they didn't go out and spend. So they are starting to spend. And if you look at services or travel, that is a big positive for a lot of consumers or families. They're out traveling, and maybe you're doing that in your own household. So they're saying, hey, we were stuck in our house for a year plus. We're going to go somewhere, and we're going to go ahead and spend that money. And so that's what's going on there. Another thing is that fast falling inflation increases the odds of that soft landing or soft recession. And we think already the recession's built into the prices we've seen. Another positive is that China and Europe on the verge of recovery. That means they're going to be buying things. And remember, Europe has been in a worse economic situation than us, but they're starting to turn the corner. In China, with all the lockdowns, are starting to turn the corner. And we think that's going to be a positive to the U.S. stock market. Another thing is consensus corporate earnings. This is what most people saying the consensus is expected to fall only modestly in 23. Now that is not what some strategists are saying. They're going to have to readjust, but we'll probably see after this earnings season whether or not they're going to have to readjust. We think it probably not. And another positive is the U.S. dollar has peaked and likely is turning over. And you can see that in the U.S. dollar. Now, when the U.S. dollar drops, remember, it's been super strong. Then what happens? U.S. corporations that do business, and a lot of corporations do business overseas internationally, will positively impact their earnings going forward. So if the U.S. dollar, if you look at the chart, has rolled over, we get a little bounce. It's bouncing around right now, but it's lower than its peak. We think we've seen the peak in the U.S. dollar, which again will be good for corporate earnings. And another thing that's really good for stocks is both volatility in the stock market measured by the VIX, and bond yields are coming down. These are all positive, and the VIX is probably the most important. But what does the bond yields falling mean? It means that the market itself, the fixed income market, doesn't believe the Fed is going to be on a course of raising rates as long as many expect, because the yields have been coming down. In fact, we are below, I think, around 340 in the yield of the 10-year. So that has come down from a peak of about 4.2. So we're seeing the bond yields drop, and we're seeing also the VIX drop, and we expect the VIX to even fall further, which are all good for stocks. Typically, the VIX is going to be much higher, the volatility, if we're going to go negative again. Now, here's another positive, post-negative, and I think I talked about this in our last meeting. When you have a negative year, 53% of the next year returns are over 20%. Now, many of them are positive. We looked at that last week. So there's a lot of positivity after you get a down year. The probabilities are that you're going to have a good year. Maybe it's in the maybe it's in the double digit, or maybe it's over 20%. But I was surprised that 53% of the time, which is the highest percentage, are greater than 20%. And we're going to look at what we expect for the S&P 500 when we get to the end. So, and also another positive, data scientists have looked at what happens when you get a strong beginning in January. Remember, the stock market ended up positive in the first 5 days, about 1.6%. Then it hit 4%. That's a good beginning. Now it's come down since then. It's still positive. But when you hit 4% in the stock market in just 10 days, that's what the yield is. So many people that are in fixed income, it would take another 350 days, 55 days to get that same return you got in the stock market. You can see how explosive stocks are. You can outperform bonds in a very short order if this thing starts to rally. We're going to talk more about that. Another thing is that when the S&P 500 is down or it's strong beginning, again, it ends up, you have a very strong first half and second half, or the rest of the year. So we're going to see what happens if that repeats, and it's 100%. When you get that strong beginning in January, typically the stock market is up strongly for the first half and the second half. We'll see if that happens again. Many people say, hey, this history repeats itself, but not exactly. But we'll see what happens this time. But it's just another indicator we're looking at. And the other thing is that the stock market's already beaten up. It's already means that the downside may be more limited. And most likely we've seen the bottom. We think we have the October bottom. We've already reached the bottom, and it's going to hang above that and begin to work its way more positive. So are we setting up for a big rally? I've got some different charts from the last time we met in 23. We think so. We'll show you some charts. This is what we talked about. Stocks tend to do well when the volatility rates are falling. You can see the top line, the top graph is the yields. And then the bottom line is the VIX, or the volatility, and they're all coming down. So we're seeing the yields come down. We're seeing the VIX come down. That is positive for stocks. Now, the Goldman Sachs Financial Index, which looks at riskless interest rates, the exchange rate, equity valuations, credit spreads, and those variables that correspond to the GDP. And if you look at it, you can see how the Goldman Sachs came down significantly, and that is the 22. You can see it's starting to fall, but look, it's turned the corner, and we think that the Goldman Sachs Financial Index, and if it goes higher, it means that conditions are improving, but they've already bottomed. And what they're saying is they don't think the financial index, which is consistent with where the yields are now and where the VIX is going, is saying that, hey, conditions are on the way to improving. We hope it's already hit the bottom, but we'll see what happens. But we think this is another sign, just like the US dollar, it's peaked at its bottom, or you would say it's hit the valley. Depends if you invert this chart, and it's on the way up. Okay, so this is a chart that shows what happens if you get a strong 5 days of the S&P 500, which we did. Strong first half and a full year follows. You can see the returns there for the full year, and what the other occasions historically where we had a strong beginning in January. You can see the average return ends up being 25.3 for the year. The median is 26.4. So this is, we hope this repeats again. And you can see in 23, we were up 1.4, a little bit less than what the others were, but where you mark that 1.4% or higher, you have a good, strong year. Now, many are saying that the corporate earnings are going to come down hard. But if you look at the consensus, there's resilience in the U.S. economy. The U.S. dollar is starting to decline. There's less profit margin pressures because the supply chain's improving, costs are coming down. The corporations have implemented a lot of cost controls, and we're heading towards really lower inflation. And you can see this is for 23, but you can see where the circle is. That's the first. We're only expecting a 3.6 drop in the earnings, and it's pretty flat the next two quarters, and then it's going to start to work its way up. Now the first one is the fourth quarter of 22, but you can see it's pretty flat or up. This is where the consensus earnings are, and then you can see earnings recovery already beginning as we get towards the end of the year. Now, post-negative year, this is just that. I already talked about this, but this is a chart showing 11% of the time you're +5 or -5 the next year, but 53% of the time, the majority, you're up over 20%. So that's significant. So when you get a down year, the probabilities are in the stock market that they'll have a great year. And this is 20% or higher. We're forecasting a little less than that, and we'll talk about that, but that's where we think we're going. All right, now I've showed this chart before, but this is a big one because early 80s, 80, 81, and 82 are very similar to us today, even much higher inflation. Volcker was the Fed chairman at the time, but you can see the drop in the S&P, and I don't know if Eric can touch on that, but you can see it was down 27%, even more than what we were at the bottom in October. But what was interesting, because the Fed started raising rates like crazy, became really hawkish. But then when the Fed chairman, Volcker, suggested that he would begin to lower rates or stop raising rates, you can see the market had already rallied beforehand. So what in history, in another high inflation period, when the Fed finally said, "Hey, we're going to stop," what happens? The stock market moved a little before that, and then you can see that it recovered most of its loss when that announcement was, and then only took 4 months to recapture the -27%. Now, this isn't history, but it was a high inflation. The Fed was hawkish, very similar to today. But you can see how quick the stock market can recover. If it smells out, the Fed is going to stop raising rates. And then when they announce it, it continues up. So you can recover very, very fast. You can see where the stock market went after that. It continued in its upward plane for some time. So this is history, but it does give us some insight on the Federal Reserve and the stock market and when they begin to shift tactics. So here we're going to show a lot of graphs that inflation is falling like a rock. We talked about this. We've been predicting this. And this is where the inflation wags the Fed or wags the dog. So we're setting up for a big shift in 23. We'll talk about when that's happening. Now you can see Here is the last 3 CPI prints. You can see it rolling over, and it's rolling over hard. And we're going to look at, if you annualize the last 3 months, we're below 3% inflation rate. Now, if the Fed's looking at trailing 12, that's a lagging indicator. But if you annualize forward, the last 3 months, we're below 3% inflation rate. Now, here's some more signs that things are rolling over. You can see the CPI, prices paid. You can see that has fallen like a rock. And look at the prices paid index and also the CPI. Well, you can see if you look to the far left, when the prices paid rolled over, the CPI rolled over hard. And so there's a correlation, and this is advanced 6 months for prices paid. But you can see that when prices paid drops, the CPI is going to head in the same direction. And this is a great indicator saying that sometime in 23, the CPI is going to fall hard, and we're already seeing it. Now, here's another indicator. We're looking at core goods and then core services. In the CPI number, you can see that core goods have rolled over very hard. You can see the yellow line has gone down straight down. I think my circle got moved there. But what it shows is that services has been a little sticky. You can see that services hasn't rolled over as much, but we're going to look at another chart that's on an annualized basis. But what happens if you look at the last 3 months annualized, just like we were talking about? If you take the last 3 months of core services ex shelter, you can see it's already annualized at 2.12%. So when you take out shelter, which is big, out of the services number, you can see that the rest of services in a 3-month forward annualized is already at 2.12%. And remember, the Fed's goal is 2%. Now, but what about shelters? Well, we're seeing the S&P prices, the S&P Case-Shiller of home prices has already rolled over. And typically, after that rolls over, historically, you'll see the shelter CPI roll over. So that's a good sign of what's to come. So we expect shelter, which will follow the prices of homes. It will begin to roll over and follow the prices very soon. Now, this is the CPI. When you break down December's CPI, you get to see what percent of the components of the CPI, and there's a lot of components, it's almost 60% are now in deflation. Now, what does that mean on a historical basis? The average historically number of CPI components that are in deflation, you can see where it is. It's around 50%. So we're 9% more of the components right today over the 50-year average of 50%. So what's happening? We're seeing a big drop in a lot of the components of the CPI, and we think that's going to be repeatable, and we'll share that at the very end. Now, here's sort of a flash. You can see the red and the green and the yellow. The yellow means it's heading potentially towards red, and this is December. But what you can see, all of a sudden, we're getting some red in some of the inflation or the economic indicators, which shows that the economy is starting to flash red. And you can see how bad it was during the financial crisis, a lot of red back in 2008 and 9. But what it shows is that parts of the economy are slowing down. So what does this mean? That the Fed's rate hike that they've been on, unprecedented, is really, since 1980, have already impacting some of the economy. And so that was the goal of the Fed. So we think, a job well done. The Fed their rate hike has already started to slow parts of the economy, and we'll have to see what happens in the next quarter. All right, so the labor market, this is a big indicator that the Fed wants to see roll over, and the labor market is showing signs of weakening. And you can see that the wage growth is already starting to roll over and at the top line, and then the hourly wages, that's come down even more. And we think that it's going to begin to drop, both of these. And this is what the Fed has been saying. Hey, we want to see the wage growth, the wages come down. We want to see wage inflation drop. Well, we're starting to see the beginning signs of that. And we believe it's going to begin to impact the CPI and all the other inflation gauges. All right, so visible progress for wages. It's actually this 3 month. Now this is another, not a 12-month look, because the other graph was 12-month looking back. This is the last 3 months. It's the lowest reading in 13 months. The last time we had wage inflation like this was January of 22. And so it's coming down in the right direction. This is the last 3 months, which I think gives you a better picture of where wage inflation is going. We think it's going to continue to drop, which is what the Fed's looking for. All right, so here's the outlook for the balance of 23. Our theme again is that inflation is going to wag the dog, which is the Federal Reserve, that they're going to be forced to slow or even stop their interest rate hikes. And we think it's going to happen in May and June. We'll talk about that. So falling inflation and labor weakness, which is already starting to happen, you can see that in the last 3 months' numbers, will shift the Fed to pivot earlier than expected. Now, there's many strategists out there, very smart people, that think the Fed is not going to drop rates or hold rates perhaps until 24. We think it's going to happen in the first half of this year. So our forecast, inflation, here it goes. The inflation continues to fall hard. Disinflation reaches shelter and wages, which is what the key the Fed's looking for. We're going to be in a soft landing or soft recession in 23, probably based on the leading indicators. We're starting to see probably a soft recession, but we think it's already priced into the stock market. So no deep recessions coming. That's our forecast. Corporate earnings come down, but no crisis. It will be sector by sector. Perhaps for example, we're seeing some bad numbers from the banks, not terrible numbers, but less than expected. But it's not going to be, we're going to see positive, we think, earnings as the rest of this quarter comes out. And it's going to be sector by sector. And once the Fed slows or even stops rates, markets should recover quickly. And we saw that in 1982 when we were in an high inflationary period. And once they stop or the markets smell out they're going to stop based on the data, then the market will recover very quickly. And we think the last Fed hike will be either May or June. And once that happens, or the investors smell that out, that's a bullish sign for stocks and bonds. So we shall see. And in fact, bonds are already smelling it out. The yields are in no indication that the Fed is going to go where most people think. And most strategists, hedge funds, and institutional funds have a lot of money. They're still very negative, and they have lots of cash. So when the Fed shows signs of stalling or lowering their hikes or even stopping hikes, that money is going to go to work. It will move fast. So when the stock market, for example, in 1982, all the institutional funds came in, all the hedge funds came in, and the recovery in 4 months took all the way back to where the bear market started. So that it's going to be fast and furious. We've used that word, I think, in the past. It's going to be violent to the upside. So how do you can anybody time that? We don't think so. I think it's difficult to know when that's going to happen, but it will be violent to the upside. So you have to work through with Eric and your advisor on how you want to position that. So we think there's a high probability of double-digit returns in 23 at the first sign of the pivot, and we think that's May or June. And the S&P forecast at the end, which is about 18% from where we are right now by year end, will start after the first sign of a pivot. And then we think by the year end, it's going to get to 4,600. But we do have a caveat here. I have it in red. So if we're thinking it's the first half. So if the Fed pivots in the second half, not the first half, which is not our base case, then it will be very difficult for stocks and bonds. A lot of volatility in the first half of 23. So thank you very
Excellent,
much.
Wonderful. Thank you for your presentation. Appreciate you as always. Can you hear me again fine?
Yes, I can.
Wonderful. With that, I'd love to open it up to any questions. So if you have a question in the room here, feel free to raise your hand. I will get it to Tom just because we don't have a microphone to pass around. If you are online and have a question, I'm going to the chat boxes right now. You can post a comment if you have a comment. If you're on LinkedIn or YouTube or Facebook, you can use the comment section. If you're on the webinar version, you can use the chat box. I am watching that, so if you have any questions, feel free to post those right now. Any in the room right now? First off,
Could you expand on the statement in red? So I don't quite understand it.
Tom, the question is, can you expand on the statement in red down there at the bottom about the timing that you were talking about?
Yeah, if the Fed doesn't show any sign of pivoting, they stay hawkish all the way through the first half, and we're thinking it's May or June. The investors will smell out the Fed is going to reverse course rather than being hawkish, become more dovish. If that does not happen in the first half, like we're expecting, then the stock market could go sideways and will be bouncing around all of the first half. Now, that's not our base case. We believe that the Fed's going to become more dovish, shift from the hawkish stance to the dovish stance sometime in May or June. So, and then we expect the stock market. Now, you got to remember that the stocks discount to the future. The stock market is always looking out in the future. So they're going to maybe look out a year. Where is it going to be in a year? And so the stock market may move in advance of this. And we saw that in 1982, where the stock market already moved before Fed Chairman Volcker said, hey, we're going to pause. So it can happen beforehand. But if we don't get any signs of a hawkish, or the investors don't think that it's going to happen, then we may see kind of a sideways high volatility move in stocks and bonds.
Roger, does that answer your question?
So basically, it means that the bond volatility will happen until the Fed stop their changing of interest rates.
Did you hear that, Tom?
Yes.
Okay,
We're going to have high volatility. The VIX hasn't shown that right now. It's in the 20s, so low 20s, even drop below that temporarily. So watch the VIX. You can get it on Yahoo Finance and see where that is. If that goes up, then what it means is there's high volatility in the stock market. And so, but what I'm seeing a shift in investment strategists' view from in 23 to be kind of like we don't go anywhere. We're going to be right around 4,000, maybe 3,900 for the year. They're saying it's not. Some are saying we're going to go to a lower low, but there's more and more strategists like me that are saying, hey, I think we're just going to be flat for the year. We're not going to really go anywhere. A lot of them are saying 4,000. We're saying 4,600. which is an 18% move from where we are by the end of the year.
Bob.
When you mean dovish, can you define
Dovish
that?
is,
Does that mean that they're gonna raise rates only 25 or 50 basis points, or does it mean they're gonna stop raising at all or decrease them?
well, as soon as they stop raising rates, then they've shifted from hawkish to kind of a middle ground, which you would call dovish. They're hawkish right now.
Does that answer your question, Bob? So is it their actions or their words?
Well, their words lead to their action, but it's their
Absolutely.
action in the final,
Bottom line is dovish means they aren't gonna raise rates or they'll decrease rates. Is that right?
well, that not necessarily decrease. They can hold rates where they are. Hawkish means they're raising rates. Dovish means they're holding rates or they're going to drop rates. We don't expect the rate drop to happen until maybe the end of 23 or even 24.
Great question.
And it all depends where all these inflation numbers go, what happens to wages, what happens to the inflation rate, what happens to the economy. If the economy gets hit harder than we're expecting, then they're going to have to begin to lower rates to turn the course, turning the big ship.
Great question. Yeah, got another one here.
To know how he thinks the debt ceiling problem is going to affect the markets.
Could you hear that?
Yes. Well, if we look at history, there's always a battle, and then somehow, some way, the politicians come together and come up with a solution. I wouldn't be too concerned about it because they always figure it out and at the last minute come up with something. So if history follows that, they're wrangling right now, but we think they'll come up with a solution. So I don't think, to answer your question, I don't think it's going to impact investments very much at all.
Good question though, Sherry. Thank you.
How are wages looked at when you talk about disinflation of wages? How are wages looked at? Is it like an average of all of the wages? How is it looked at?
Can you,
Well, they
Tom?
break it out
Did you hear
into,
that okay?
yeah, I heard.
How are wages looked at and calculated in inflation?
Yeah.
Well, when they break it out from salary wages and then hourly wages. So they have it in two pieces. And so they combine those together in the wage number. I'd have to look exactly how the weighting is, but it's hourly wage and salary wage. And it's been coming down the last 3 months slightly, which is exactly what the Fed's looking for.
So when you're talking about it coming down, does that mean that they're laying off higher waged people and moving the average down?
It's the inflation rate of wages.
The value of their wages.
Yeah, inflation rate.
Good question. Any other questions in the room here? I'll check the chat box online here again. If you're online, feel free to post a question. I do see a number of you out there. No questions online, Tom. Bob, you got one? Yeah.
When you talk about CPI, you're pulling the housing market out of it. I don't understand why the housing market gets pulled out since it's such a huge part of our economy.
We just pulled it out on that one number to show that services are coming down. It's not pulled out of the CPI. And recently, we don't have a chart in here, but the PPI just came out, and it's annualizing at about 2.16% 3 months forward. So the PPI, which is prices paid, is now, if you take the last 3 months and annualize it, it's at 2.16%. So both CPI in totality with the housing is less than 3% 3 months annualized forward. So some of the charts did not take that out. There was one chart that showed that.
So I
What
think the
I'm
question is,
looking at
why
earlier-
did you take that out?
Because we're just looking at the balance of, you have services, which seems to be holding in there sticky. But when we just take out the housing, we made a case that when you take the housing out, services are already rolling over the balance without housing. But then we showed a chart that the leading indicator to housing is the housing prices. When that drops, which it already has, then the housing inflation will begin to come down. We just broke it out for those charts to show that we think there's evidence that it's going to fall very soon, because it is a big piece of the CPI. But beyond, when you include it, the CPI is still the last 3 months averaging below 3%.
Does that make sense? Kind of breaking down, looking deeper than just the big number. Yeah.
We're looking at where it's going to be going by, and what I showed was, again, that services X shelter is coming down. But then we showed another chart after that showed that that the leading indicator to shelter inflation coming down has already fallen, and historically we expect shelter to come down, and that's the prices of housing. When the price of houses fall, which it is, then shelter follows.
Got it.
Good question. Thank you. Cool. Anybody else? Love these questions, you guys. Job well done. No questions online. I think we're good in the room. Thumbs up. All right. Well, as always, Tom, thank you so much for all of the wonderful information, the objective analysis of what's going on. I think we need more of that in today's world. So thank you.
You're welcome. So, we spent a lot of time on inflation, and the reason is that's the key to the direction of the Fed, which then is the direction of the stock market. And that's why we had a lot of charts today on inflation. But thank you very much. Appreciate it.
Yeah, you're out in Nevada. Have a great rest of your time with your daughter, and we will see you in the office here soon. Everyone online, and in the room, that concludes our call here today. So I'm going to go ahead and sign us off. If you have any questions in the recording, feel free to email me. We would love to take those questions and get back to you. If you think of a question later, those of you who are here live, by all means, reach out to us. We love taking those questions. So again, thank you everyone for taking the time out of your busy schedules to be on this presentation. That concludes our call. Everyone have a wonderful rest of your day.
Thank you.